AI had a lot of lofty goals back then that it's now delivering on like a decade later. And crypto is, very much a similar position, though I would say probably growing and delivering on promises more quickly.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show.
Soona, thank you so much for coming on. Really excited to chat with you. All right, Soona, you're the founder and managing partner of Volt Capital. Volt is an early stage venture fund focused on the digital asset sector. Previously, you were an early hire at the agentic data intelligence company, Alation, and founded Token Daily, which ended up turning into On Deck. All right, so on your personal website, you have a small little bio. A part of it says that you worked at Alation, and you said you worked at it during the AI dark ages. Can you explain more about that?
When I was at Elation, AI was not sexy. It did not feel like the new hot thing. It was, in fact, there was really strong skepticism around its promises. And so I think the big pushback we would get before AI today, there was this wave of it's not AI, it's actually ML. And there's this contention around semantics, if it's ML or AI. But back then, the contention was, is this Excel VLOOKUP? Like that's how primitive and early it felt. And I don't think that's unlike crypto today. Like AI had a lot of lofty goals back then that it's now delivering on like a decade later. And crypto is, very much a similar position, though I would say probably growing and delivering on promises more quickly. And we see that with like $28 trillion in stable coins transacted last year, right? So I'm used to being in spaces where there's skepticism around ambitious, lofty goals that the sector is promising to deliver on, and it's realized in the fullness of time. So a key takeaway has just been patience and staying heads down and doing the work.
With Alation, did you have like a broader thesis on AI? Were you thinking like, oh my gosh, AI is going to be really big in the future, I should join this company like now because maybe I'll catch that wave? Or what was the thought process?
I mean, it was very pragmatic. It was like, okay, these are going to create productivity gains. And this is a new technology. All the smartest people I know are working on it. I think it's going to continue to become more important in a similar way that when I was building products, and we'll get into this in a little bit, I'm sure, at University of Michigan, we'd accept payment in USD, Euros, Bitcoin, and Dogecoin because that's were like the only major cryptocurrencies at the time. It preceded, the Ethereum yellow paper and Ethereum launch. And at the time, it was just a way to accept payments or value, right? It wasn't, fast forward 10 years later, there's been these like massive geopolitical consequences around crypto. But at the time, it was just a way to accept payments in the way that AI was a way to kind of incur, just have productivity gains. So really, I think that you buy into like a big North Star, but you need to first think about what's the preliminary use case this is solving. And does that make sense to you? Is it useful? If it's useful to you, it's probably useful to others. And Chris Dixon is absolutely right when he says the next big thing really does start out looking like a toy or like is a little bit innocuous. Like you don't start out with these like major grand visions and then, and that's what it looks like from day one. They start out a little bit innocent, right? And you don't really they kind of creep up on you and you don't really see them coming unless you're paying attention.
Wait, so you mentioned that at Michigan you were building products that accepted crypto. That wasn't Token Daily, was it?
No. So this was during Amhaz. So this was on the heels of The Social Network. The movie just come out, I believe it was like early 2010s. It was like 2012, 2013. And all college campuses were buzzing with, particularly across CS departments, with just the potential of you creating the next Facebook. And it really glamorized the road to building Facebook and what the startup life was all about. And so there's this massive wave of hackathon series that started across all these college campuses. And so we would build products during MHacks or like these hackathons that would accept Bitcoin. And they were just fun ways to hack together these side projects that would accept that would that would be built on or use cryptocurrencies in some way. I did start Token Daily later. That was after my work at Alation. I realized the software layer of the crypto stack was starting to be built out. And when I graduated, it was largely just mining companies, and hardware companies are really tough. The economics are just starting to make sense. Back then, it was pretty bleak in terms of what CapEx and OpEx looked like. Um, but as a software layer stack was being built out, I realized there could be potential for asymmetric upside and building something that really captured the value that was being created as crypto started hitting mainstream. And I built out a platform that would accept, well, what it did is it socialized investing. It added a social graph. You could invest with your friends. You would learn about assets. This was really, I think, before at the time Asari was launching, it was before the block. Like this was very, very early days. We did not have really reputable news sources in crypto. And you know, I don't believe Blockworks was around at the time, and so this was a way to get that education, but also invest alongside your friends. And then we ended up pivoting the company to a general tech company, and that's now today on deck.
Amazing. Wow. Okay. Okay. So I want to go back to this story about the hackathons. So you're talking what 2013 era? The people were hacking up products like crypto products, or they were hacking up traditional tech products and paying in crypto, or like tell me about that.
Um, we would create these random side projects and it'd be like send BT, like you could send BTC as like as an additional method of payment. And so it wasn't focused, there weren't companies that were focused on crypto, and there were just fun ways to hack around wallet creation. And they were also doing this at MIT. Like it was it was the era of the tinkerers, I guess, in the way that people are tinkering now with AI technologies across campuses.
That's so cool. Okay. So at what stage did you decide to leave Elation and start Token Daily? Because, AI, obviously AI is like the hot thing today, but crypto was also like not a hot thing, right? So why did you decide to go all in on crypto, especially back in, I think I remember reading Token Daily like in 18, definitely. I don't recall if it was 17, but it was super, super early.
Yeah, yeah, it started in 17. I mean, I'd been in crypto since college. I love frontier technologies. Okay, so I started out at Michigan studying biomedical engineering. I was in the AI space early, and we would also, debate and build products around crypto in college. And so I've always loved frontier, nascent, emerging tech categories. I think that's where all the magic is. There's so much potential, and I like to be there where there's like a lot of clay to work with, and everything you do makes an impact. And it feels like the future of it isn't really solidified or concrete yet. Um, and I decided to make a leap and build a company in crypto when I noticed that the software layer was being built out, and a lot of the um, more the infrastructure was laid out, more companies were building software products versus pure hardware companies, which are obviously way lower in the infra stack. And it felt like we were hitting more of a critical mass in terms of being able to get users to the platform that we were building. And so it was kind of like entering the space formally or building company formally on a risk adjusted basis, right? It's like taking the leap in terms of potential upside, but also enough work had been done that there was an existing user base to tap into. You weren't creating a net new category. Um, and a lot of the rails to build out companies that you wanted to see in crypto had already been laid out. So that was roughly the timing assessment I was doing and trying calculus around starting.
Very cool. Okay. So Token Daily, at what stage did you decide to launch Volt? Because going from, I think that Volt was in 2019. Is that right?
I mean, we started dog formation. Yeah, I was starting to think about it in 2019, putting together SPVs for companies to invest in. It was like such a prime year to do it. But it's interesting. The best time to deploy is not the best time to raise, and vice versa. The best time to raise is, definitely not the best time to be deploying. And so that's all to say people were very bearish on crypto, even though, I mean, those vintages were like Uniswap, Optimism, like just like hit after hit. But it was viewed as too risky post the early 2018, like 27, I believe 2018 crash. Um, so so it wasn't we didn't actually launch Volt until 2021.
Yeah, perfect.
So, um, we we were going through the pivot from a crypto company to a general tech company for On Deck, and I was reflecting on my journey, and I realized, like, the biggest pain point I had as a founder was that, none of the funds that we'd taken capital from had GPs or fund managers that were actually operators before. And this in general is a problem in the crypto space more broadly, is there are very few relative to the number of funds in crypto, very few managed by former operators who've actually done the work of launching a company and hiring people and scaling it, executing to a roadmap, building internal and external momentum, like just a lot of the intangibles that come with taking on capital from a fund that a founder would really benefit from having someone who's been on the who's actually done it. And so I set out to build the fund that I wish I had on my cap table. And that was the reason we started. Like that gap in the crypto market ended up being our edge as a fund. You know, my partner Jane at the fund, she also has founded the Horizon, just like a part of the founding team, co-founder. They hit 2 billion in FDV at peak. Um, Rob Serro was one of the first hires at Delphi Digital, and so really helped grow that team out and we build it from day one. So everyone in the partnership has had that kind of founding experience in terms of getting something from like 0 to 1, and that's been immensely valuable for our founders. It's interesting because it's not as legible to LPs or people that are a little bit removed from direct deals and direct companies, but it makes a world's difference for founders. They kind of view you as like their kind, like, 'cause you're on the opposite side of the table, and so oftentimes there's this, like, false hierarchy that is established or people, I'm you know, you've seen the kind of the tiresome jokes around VCs, like, not getting it, and they're not really putting all their, eggs in one basket in the way that founders are, and they don't know the risk profile. It's like the lazy way out or something. But many of them, like, in general tech have been founders before. And so they earn their stripes, they earn the ability to coach these founders. And a lot of times in crypto, all these funds, I just don't believe have earned the right to be investing and guiding founders because they haven't gone through it themselves and founded a company before and really have like the scar tissue to be able to speak from the place of experience. And so that was incredibly important to me, and it's really resonated with founders. I think they consistently tell us, like, there's this huge difference between the kind of advice that we give them and the things we help them with and how we're able to anticipate things around the corner or help them shift priorities. And it's like, yeah, because we've done it before. Like, we can see it coming. It's not like our first rodeo. So
That's very cool. Yeah, no, I mean, from personal experience, that makes total sense to me just because there is often there's it's I think I forget the terminology you use, but there is kind of this hierarchy a little bit where the founder does feel like, okay, that this VC is kind of one level above where I'm at, but then if you have experience like in the trenches, so to speak, then they do.
there's a level of mutual respect
Yeah,
and a deep empathy for what the founder is giving up. It is hard to be. There is no playbook. There's no one that's got, like, when you're watching a founder from the seats, like, oh, I would do this, I would do that. But like, you have to think like every single day, particularly in the earliest days, there's like infinitely many choices they can make. And so just the idea of understanding what is going on and what to prioritize, like things just as simple as that don't hold much gravity for people that haven't been founders before. But once you're a founder, you realize just how paralyzing it can be if you don't have someone guiding you and showing you and helping you with frameworks on how to make decisions. If you think about the funds that have built a strong reputation in the space and have created more like these legacy brands around them, from the top, they've been founders. Like there aren't that many, but the ones that have done a good job have done it over multiple cycles. Like um, obviously Andreessen with Chris Dixon, but then also Paradigm with Matt and Fred, both having been operators before and company founders. Variant with Jesse, Multicoin. Kyle and Tushard actually founded a company together before. Framework as well with Michael and Vance. So it is a a pretty strong correlation in terms of the funds that end up really building a legacy. Because at the end of the day, you're building a business, and so having done it before it puts you at a massive advantage.
Totally. So were you, I mean, you also mentioned, 0 to 1 founders or early stage. I assume that you focus exclusively on pre-seed seed, or do you also, participate in A and B, or is it primarily early?
Primary focus is pre-seed seed. I think you've seen a lot of funds go through scope creep, where they initially start off as super early stage and now they're squarely a Series A fund or later. And there's been this kind of runaway valuation, cases of these runaway valuations, and there are funds that will invest in them at those prices. But I believe in firmly doubling down on what your edge is and being disciplined around a strategy. And so we've stayed focused on pre-seed and seed, and that's our wheelhouse as a fund.
And when you're looking at the landscape, crypto is super diverse. Back in the day, it was less diverse, but now there's like many different subsectors. Do you decide early on, hey, we want to be crypto broadly, or did you also was there a sub focus that you guys were really excited about early on? You wanted to lean more that way.
Yeah, so we've always been generalists in crypto. Crypto itself is niche enough. There's no reason to pigeonhole yourself further into betting on only one vertical within crypto. In fact, I think that's you're going to miss a lot of great opportunity for just a cross pollination across products, across companies, across founders, just sticking to one lane. And we haven't even seen the fullness of the verticals play out. Like how are you to bet on, or how are you going to bet on one vertical when I mean, like even just the robotics crypto category just popped up this year, right? So it's premature to do that. So we've always stayed generalists, but there are trends you can see around how the space is evolving over time, right? So I think today there's a bit of at least we're taking a barbell strategy, and this is mirroring what's going on in the space as a whole. Is there's the technologies that are mature, and these are like crypto as a financial primitive. So these were the things that we were investing in 4 or 5 years ago, right? Like stable coins. Like we made the investment in squads in like 2020 or 2021. It was a fun one bet. And Stepan and the entire team, like they're incredible. They just announced a partnership with Stripe. They have, you can see from all their progress, they've grown tremendously. But they started at a time when stablecoins were not really stress tested on the global stage. It was an open question about whether or not stablecoins would quote unquote work. And that is no longer the case, right? They're like really, really mature. It's a more mature and consensus bet now. And so the question is, can you win on distribution? Once the tech is solidified and, all the kinks have been worked out, it's a question of whether you can win on distribution. And so we're seeing companies that are building in RWAs, which I also consider like more of a mature relative to pre-seed seed venture investing, mature technology. There isn't really an open question about whether or not they're going to work. It's just a question of like, can you capture enough distribution, create a category and market? So that is the mature technology, capture distribution, financial primitives for crypto. And there's also them, right? Tokenized equities, RWA, stablecoins, like a DeFi is in that category. So think of those kinds of products. And then there are the true 0 to 1 technologies. These are the ones that have not been proven out. These are where stablecoins were 5 to 7 years ago. Like, is this going to even work? Can it work on a global stage? And the technologies here, I think there's 2 camps right now. Maybe there'll be more in the future, but it's squarely DePIN, the intersection of like crypto and deep tech, or crypto and AI and its derivatives. And so that's like crypto and robotics. And so those are like the unproven technologies that are just starting, and you have to wade through a lot of the noise to get to the high signal, high quality projects.
All right, so within that barbell, we're talking, mature crypto technologies, but it was just crazy to say because back in the day, like there was none, but that's wild. And the kind of the more 0 to 1 early stage, we're not sure if this is even going to work out. Within that early stage bucket, like how do you know? Like, because obviously, like you have to have some sort of like idea that okay, crypto robotics does make sense, crypto deep in does make sense. Like, what if there's a category that is totally new? It will, whatever name that we make up. how do you know if that's real or just to make, like, it doesn't make any sense? Of course, you can try to, follow the logic of the founders and kind of, build out your thesis, but like, is it really just like you're kind of making a best guess?
So you can never know for sure, and the game of venture is operating with like 60 to 70% of the information that you can have at any given time, probably even less in a lot of instances. And so you'll never have 100% certainty, otherwise it would be venture. But there are ways to tell and ways that improve the odds of something being a technology that will last multiple cycles and really have staying power. One of the major things, and I said it earlier, and I think it sounds simple, but it really bears repeating because it is actually a very powerful metric, and people I think don't index on it as much because it seems so obvious. But with crypto and with AI, just like even like why even getting into those verticals is what you asked. So, like, why do you do crypto? Why did you see the vision for AI beforehand? It was like, is there something that this is solving for that this uniquely solves for that nothing else solves for right now? Like truly, like going back to the basics, and I guess you could call like first principles thinking, but truly, like, is there a use case that this uniquely solves? And then working from there. So stable coins, having global liquidity instruments where you don't have a take rate that's going to any of like the centralized intermediaries, you being able to transact value across borders without intermediaries is a massive unlock. And of course, makes a lot of sense for remittance corridors. It's just like a net new. So stable coins, as long as US dollar or as long as a currency has an exposure to that currency has value to users, routes or paths to getting that exposure are always going to be valuable, particularly when you can do it in ways where the margins are net better for businesses and meaningfully move the bottom line. And so that for us, like, was such a no-brainer that stable coins were going to be a thing. Also, being a student of history, like if you went to the Bitcoin top forums, stable coins were written about I mean, Hal Finney was writing about stable coins. And prediction markets actually were also in Bitcoin talk forums. And now you're seeing them, I guess 14 years later, finally be realized in the fullness of time. I mean, Polymarket just announced the $2 billion capital injection and $9 billion valuation. But you're talking about like threads in like 2011, 2012. Right. So, so things are uniquely unlocked through crypto, and so when we're looking at more of the frontier-facing technology, so like, is this going to be something that has staying power, or is this a meme that is getting momentum and will collapse just as fast? Look at the use cases they're actually being deployed or they're actually being used for. So, for instance, we made an investment in a team that's building at the intersection of crypto and robotics. They built 2 robotics companies before. And they're like, actually, we came across this problem in our last company and realized that crypto is the primitive that solves for this. If there was another way to do it, we would have done it because we're not, they're like, we're not crypto founders first. They did recruit a crypto co-founder, but they themselves, were not crypto native or crypto first. And the idea is to give a more succinct version of a very long context dependent pitch is you can upload footage to help train robots because there's no common crawl equivalent for robotics. Common crawl is all the user generated content we've generated over the last 20 years. It's used to train the models that we have today, like Reddit comments, things like that, that we use for current LLMs. In order to train robots without having to depend on physical sensors, you can give them footage. So DeepMind had a paper they released last year where they trained robots on playing soccer purely through point of view footage, or egocentric vision data is what it's called. And it's like a massive unlock in terms of efficiency of training. And so the problem is you need high fidelity data. You need it to be at certain angles, certain height, and you need a lot of it. And that's for you a pretty diverse set of data. And so the team is like, look, we can probably on the protocol level incentivize users and give them a carrot to upload video footage. But then the stick, and this is the part that requires a protocol, is slashing them for uploading suboptimal data that can't be used. And you can gamify it such that you're making sure that validators and users are being honest. And you can streamline this on the protocol level and do it on a global scale with margins that make sense. And so all of a sudden, data marketplaces start becoming more economically sound models in crypto versus having to have the overhead liability that comes with building this in more of a centralized fashion. So you can get all the data inputted without the balance sheet of like a Tesla to collect the data, and then also the quality assurance and like data labeling that you see with other companies that focus purely on that side of the business. So that's one example. There's a team that's doing something similar. It's actually a very similar model, and I think this is the model that data marketplaces are coalescing around for DeepIn. It's called SkyMapper. It's a team out of SETI Research, and it's actually one of the lead astronomers there. He's Frank Marcius. He also founded a company called Unistellar, which he scaled to double-digit millions in revenue. It's an electronic telescope company. When you ask engineers at like NASA and SpaceX and Blue Origin, like what are the downstream implications of a trend like that is so stark and so clearly meaningful. One piece of it is we're going to need better anti-collision software, and we're going to need better tracking in the sky, and this is known as like eyes in the sky data. This is up to the minute dynamic data that's always changing, and in order to track it now, you can book out commercial grade telescopes, but they're usually booked out days, if not weeks in advance, and so data is pretty stale by the time you get it. If it's even at the location you need, like sometimes you need data on or footage of something that maybe it's like best viewed from Fiji, and where the sky is clear and it's not on a foggy day in New York City. And so the ability to type in a bid, like be able to request some footage from a telescope that's deployed all the way from Fiji while you're sitting in New York, and then change the coordinates on telescope such that it points to that exact object that you need. I mean, it's a very powerful thing. And then you reward these hobbyist astronomers that are already recording the night sky through their telescopes anyway. And on the demand side, these companies are paying for permissioned access to what is essentially like citizen astronomy, like all this footage of eyes on the sky data. And so there's like really cool companies being built across space, across robotics, that are capitalizing on fringe, up to the minute, like really hard to capture data that is dynamic and changing over time. Another theme across frontier tech that we actually decided as a firm not to invest in venture, and decided is actually probably better done at a corporate level. And it's good to understand this distinction when you ask about like what has staying power. Another level of question is like, what is best suited for a startup to build versus what will be rolled out by incumbents? Because while innovator's dilemma is a problem for incumbents, like oftentimes startups win just by sheer agility alone and the ability to experiment, and not have to bring on an entire user base along with them, or a public market that has to listen to quarterly calls about how the company's doing. Sometimes they win on the ability to not have to deal with innovator's dilemma by itself, but sometimes they don't. And you as an investor need to be able to delineate which one you're looking at and what the case is. And so I know agentic payments was a huge meta. Do you remember this, where everyone was talking about, I mean, people are still talking about agentic payments. And I think there were like 1,000 of these startups who are just focused on allowing agents to tether a wallet to an agent and allow them to execute tasks on your behalf and be able to pay. It's like, okay, truly, what is the tech moat around giving a wallet to an agent? Like, there really was none. And I don't think any of them were being built out vertically or horizontally in a way that was going to capture any moat. And so from the inception of that category, we were like, this is going to be built out by Coinbase. Like, we actually had said internally, like, we think this is going to be built out by Coinbase, and they will roll it out. And the only differentiator that startup has, like the only way that you can differentiate and win, is if you capture the most users and just have a massive distribution funnel to start off with, which obviously is not a startup's sweet spot, or what they're usually going in on, banking on having that be an advantage, is an already existing massive user base. That's usually an incumbent or a larger company that's best equipped to do that, and that puts them at a great advantage. And then we saw X402 rolled out. Cloudflare launched Net, and they're also focusing on agentic payments. And so it was really cool to see what we anticipated happening anyway. That kind of mantle being taken up by, I think, the appropriate companies to build it, that are in the best position to bring it to life. And so there are really interesting things happening both across enterprise and startups on the intersection of frontier tech and crypto.
It's very cool. Okay, so that first one, the robotic one sounds a bit like Numerai, but with robot data instead of like kind of hedge fund, market data. And then the second one, I think you could, it was SkyMapper. That's so cool that it's hot. I thought you were talking about professional, uh, uh,
No, they're hobbyists.
yeah, hobbyist telescopes. So they're getting incentivized via token in order to collect that data and share it to the network.
Yeah. And so if you think about it, a lot of the burden of deep networks is that they require the user to buy some hardware for a few $100 or something. And by the time it's break even, I mean, it takes a long time. And so you just never know what anyone's economic situation is. You don't know their motives or incentives going into participating in the network. Sometimes it is just to make side cash, whatever it may be. But the neat thing about SkyMapper is these are hobbyist astronomers that have the hardware anyway.
That's super cool. It's funny. I was last night. I was looking at hobby telescopes. I'm in Chicago, so not like super useful. But I was like, I really want to buy one. So maybe I'm gonna Google that one.
It is incredible to me, just anecdotally, I haven't seen the numbers, but just how many people have become hobbyist astronomers just over the last 5 years. But a lot of people in crypto I know that were some of the, I guess, like, forefathers or, like, a lot of the, older, Bitcoin Core generation that are, now, um, uh, doing they're just doing, I guess, space photography is like the best way to put it. I one of my sisters does it as a hobby. I mean, it's just anecdotally, maybe I'm just paying more attention to it, but I'm just seeing it everywhere. I bet you there's an uptick. You should research. You should let me know if there's data that backs this up.
You're the first person that said that, which is crazy because I was like, okay, if I capture these incredible celestial bodies, like how can I take pictures of them? And I was then looking up the how do I get the picture that be right and everything. So either there's some weird correlate between like if you're in crypto, you probably like space, or or maybe we're just all getting older and like like as you get older, you just like weird things. So maybe
But this is like the new bird watching,
yeah,
or
exactly.
like body
Yeah.
watching.
And I'm sure there's also a connection between SpaceX and like SpaceX's success and people getting into space more because it's like it's not so distant. It's like, oh, we're sending rockets every day. Now it's more realistic. So I'm sure in like 5 years time,
Again.
yeah, I'm sure in some years time there's going to be crypto in space and we'll be launching satellites or some stuff. But it's going to get pretty crazy. All right, so how are you when you're trying to identify these different, I guess we'll call them like subsectors? Are you formulating theses in your own mind about what you're seeing with your team and formulating a thesis and then going to try to identify founders within that? Or are you getting deal flow and, reaching out to people and talking and having conversations and then the thesis kind of bubbles up from there? Like, is it intentional or is it like you're kind of more passive?
Yeah. Well, you always have to be intentional. You cannot win pre-seed, seed, early stage venture on the defensive. You have to be on the offense. You have to be actively, fighting for every deal you get. You have to be, yeah, you can't be passive. You have to take a very active strategy. But in terms of whether it's top down or bottoms up, so we do both. The emphasis is on bottoms up. So it's founder first. Um, I am a founder first investor, and the rest of the team actually we all are. We're not market first. The idea is you are ultimately betting on the person to either validate the hypothesis that this is the right market after you give them capital, this is the right market, continue doubling down on them, scale a team, expand to products that make sense within that vertical, or to test a hypothesis, realize that this isn't the right market, and then pivot to a more attractive market, right? Like, there's this line I always say, and I truly believe it's like good founders don't stay in bad markets. And you saw this with Figma was a pivot, Scale was a pivot. You just go through the roster and it's just like one, like so many of these multi-billion dollar, multi-generational companies actually were Slack as well was a pivot. Um, so, so we're founder first. And one of the strongest correlates and one of the strongest data points in terms of whether or not somebody's going to be a successful founder is actually if they founded something before. Um, and that could be a company, that could be something within a larger organization, but it's all their own and they recruited people and led a team. But having founded something before is a huge tell. That doesn't mean that's all we invest in, and we obviously are open to first time founders, but it does help to have some experience of being either starting initiatives under yourself or having been exceptional in something like gaming or just something where it took a lot of effort, discipline, and strategy to make it out on top. Um, So we're founder first, and then we do have some top down or like market first investing that we do, and some levers we pull to do that are we have this semi annual asset that we roll out every so often called their RFPs, our Volt RFPs, and what they are is they are just requests for products, like things that we think are intellectually interesting, where we see the space going. Actually, the crypto robotics play was one of these where we were looking at what was going on in Silicon Valley. It was like on the heels of the AI wave, robotics is starting to take off, which makes sense, right? Because robotics is the substantiation of AI and just kind of giving the brain a body. And we're like, okay, like that wave will probably mirror what's going on in crypto as well. What are the potential intersections if there are any? And then we put the RFP out. I think there were like 2 companies building at the intersection of robotics and crypto. And then by the time we made the investment in Prisma X, there were I believe about 9. And so RFPs are really helpful. There are some things we have internally that allow us to analyze signals in the market in terms of, people that might be leaving to start their own thing. And we also have a program called Forum, and that is a very early stage workshop series with some of the top founders across general tech that help give um, guidance off the record. These are closed door sessions to our pre-seed founders around a specific aspect or topic around company building. So it could be like how to create a strong operational foundation from day one, how to recruit well, how to build momentum. Like it really runs the gamut because there's so many things you're responsible for super early on when you're starting a company. But, yeah, there are a lot of different levers that we pull to lead us, the best and brightest, that are really bringing forth the next generation of A-plus crypto companies.
Very cool. Hey, can you talk to me about your diligence process once you find what you believe to be a great founder, a great founding team, and building an exciting product in a great market? What does your diligence process look like?
We are optimizing for 2 things. It's speed and thoroughness. Every day counts in general for everyone's lives, but even more so for founders. Like it's like every 24 hours really, really matters. And so you just don't want to waste their time and drag it out. And so, we will source a company, source a founder. We initially, if there's like a product or a prototype, we want to be able to use that. Like if it's delightful to us, it will of course be delightful to others. And so that's something that we if it's available to us, want to be able to use. But again, at pre-seed and seed, you're really investing sometimes in just an idea or just getting started. We look at past work that they've done. Like I told you, being a repeat founder, while it's not a requirement, is very helpful. And so I see what they built before and the people who work with them. How do they find working with them? Are they clear leaders? Are they succinct? Are they able to set a vision and execute to it? Are they timely? Are they dependable? Are they ethical? It's a big one. And so um, previous work is a massive indicator for future performance. Is really how I view it. People really don't change just how they are and how they show up. Um, Using the product. We obviously do market research, but look, like the best companies are creating a market. They're like the market leaders, and we really do want to be able to plant a flag or take a bet on a first mover. And so, oftentimes you can do tangential market research, but there's this the lore around Uber is that if you thought the market was just taxis, you would have missed the true market, which is anyone with a car. And so, we do market research, do competitive research, but we are looking for more net new categories, net new markets, and so oftentimes there's not really too much to go off of there. Um, we're obviously doing reference checks, and yeah, and between the product and ultimately what it comes down to is your diligence the product and diligencing the founder. And if we believe it's a market that can get big enough, then we get the check. And usually our diligence process is around 2 weeks. We try not to go over 2 ICs, and we have an IC weekly. And that's something that's really stood out to the founders that we talked to. They repeatedly have like really been like, "Wow, you guys gave us a set deadline and met it in terms, or even beat it in terms of when you'd get back. And if I wish every fund did that, because when I was a founder, it was investors who dragged their feet were just such a waste of time. And so it's very important to me that we don't do the same thing to the founders that we work with.
When you're looking at these different companies, are you primarily focused on equity or token, or do you generally do equity with a token warrant, or what do you?
Oh, majority, Andrew, I'm sure you've seen majority deals now, majority of these companies are safes with token warrants. Like 95%. Like you'd be hard, like it's hard to find pure equity deals or pure token deals these days. Like no one's really any people are rarely investing in just SAFs. And most of the prudent, crypto founders are not only raising on safes to preserve optionality in terms of being able to tokenize down the line. And so I would say 95% of companies now in crypto have safes with token warrants.
Where do you prefer the value accrue? Because I know within that structure, it's like sometimes the value accrues to the token, sometimes equity. What do you prefer?
Fundamentally, what I prefer is that you have a revenue generating business. I know it sounds a little heretical sometimes to say, depending on which demographic you're talking to in crypto, but it is where the space is trending. Exchanges are now requiring seeing a certain level of revenue, annually. Um, there's this emphasis on making sure that the cash flows make sense. There's scalable quality of revenue coming in for a service that is not just moving one lump of capital from one protocol to the next. And if that ends up accruing to purely equity, or if that ends up being translated into the tokens, like ultimately we're looking for a multi-billion-dollar outcome, and the instrument that the value accrues to should be secondary to that. But I am really excited to see, and it's been awesome to see more, experiments around long-term sustainable value for tokens. And obviously, I'm sure you've seen all the um, features and products coming out around tokenized equities. And so maybe they end up being one and the same.
Yeah. So if the value is accruing to a token, what is the ideal tokenomics? Like, do you prefer the revenue to be used to buy and burn the token, or some sort of mechanism like that? Like, what is the perfect tokenomic structure? I know it's a
You're not asking what the perfect tokenomic structure is.
yeah, it depends on the product, and there's a million different things. But like, if you could just wave a magic wand and be like, "Hey, I wish."
It's not one size fits all. It's not. Like, and actually, this is actually a huge part of what we're doing on the DeepIn side with our research engineer Mustafa, is putting a lot of academic rigor, for instance, behind DeepIn network architecture, how to use control theory, things like, because the problem is, if you look at DeFi, there's a lot of academic rigor behind network design for DeFi protocols, for instance, and what best practices are and what an optimal network design might look like. And then you look at DeepIn, and it's just a lot of founders that are copy pasting some fundamentals from DeFi and creating this like Frankenstein DeepIn network that doesn't really account for there's just different external forces on DeepIn projects. The nodes are fundamentally different. Oftentimes there's like a hardware component. And we have research coming out that actually goes into the minutia of what are the ways network design is fundamentally different in DeepIn than it is in DeFi. And so that's just a very long roundabout way to say it really is product and market dependent. I think one of the biggest um, kind of fallacies we've had as a space from like last generation, previous seasons, is not carrying over to this next generation, is that people are becoming more sophisticated around different models for value accrual.
Yeah, one of the things I think about is the number of tokens is, yeah, obviously extremely large right now. But if we're relying on, if there is going to is if a broad consensus is, hey, the revenue that's generated needs to go to the token in some capacity. If you do have a token, then yeah, don't you think that the like what ends up being the need for tokens if you have securities, like especially on-chain securities that kind of can be traded on exchanges and whatnot? Like, are tokens going to be more popular or less popular going forward? I feel like that's kind of the ultimate ultimate question there.
Yeah, it's interesting, and this is actually some of the kind of pushback that's come from a lot of the core developers across different protocols is that, if the emphasis is on tokenizing SpaceX and OpenAI, do people just care about exogenous assets versus endogenous ones? Like, really, what's the value? Like, for all of these crypto companies that are tokenizing, do they really hold weight in a public market when they're up against something like SpaceX or OpenAI? And obviously, retail would tell you, if you're looking at retail more broadly, just globally, something as legible as a SpaceX or OpenAI is going to be favored every time over something that's like less legible than like any choose your own endogenous crypto asset. I think there is a demographic and market for, and this goes more into the traditional finance crypto bucket, that we also would probably put RWAs in, and that's just a different user. But there are obviously there's different utility for different tokens as well. It's like apples to oranges. There isn't just like, is this going to be net more valuable to people in general? I think there's just this understanding that it's just different. And so let me paint an example is like there are Amazon shares, but then there are like AWS credits, right? And if you think about it, like every company, I mean, a lot of companies, particularly ones that are like really nailing brand and doing it right, have their own currency already, like a representative currency, right? So for Amazon's AWS credits, for Roblox, it's Robux. For Replit, it's Ripples. And in that way, you can think of some endogenous tokens as being the equivalent of like an AWS credit. Obviously, more sophisticated and like really simplifying, versus what tokenized equities are, which is as you're describing, like the actual share that's traded on a public market.
Yeah, no, that's a super, super interesting rabbit hole to kind of go down there. Um, and yeah, it's like, will most successful companies end up launching some form of their own in-platform currency, and
Hmm.
so yeah, no, it's a very, I mean, we have a whole podcast on that, but all right. So I want to switch gears here a little bit and talk about portfolio construction. How do you think about constructing the portfolio within your fund? And is that really informed by fund size, or do you think a fund size is kind of a indicator of portfolio construction? But I like to construct my portfolio this way.
So, fund construction is more art than science. Everyone has a different method in terms of what they think is optimal. Um, so there are funds that are structured more like a founder's fund that will put 20-30% of the fund in one position, and there are funds that take a very different approach that will have more of a spray and pray model where ownership really isn't questioned. It's just a matter of access, and then trying to ride that to um, to decent fund multiple or return. The idea is you want to optimize for enough concentration that any one bet can return the fund multiple times over, but enough serendipity and service area that you're getting exposure to different narratives developing over time. And so when you run the math, and we've done like run fund allocation models, like typically that number ends up being anywhere from depending on how you allocate, anywhere between 20 to 25 core positions. Um, and that usually doesn't change based on the fund AUM. What changes is the number of dollars that each of those positions equates to. And it also depends on the ownership target you're trying to hit. But typically you see funds really optimized for that 20 to 25 positions per fund. That seems to be the sweet spot in terms of getting enough serendipity, but also enough concentration and depth to make any one investment matter.
And how do you think about the exit on the token side? Because tokens are a funny creature; they become liquid generally much faster than equity. So, how do you decide when to exit?
So it is interesting because at some point it's almost like running a hedge fund and a venture fund simultaneously because these unlock and become liquid. So there are 3 primary things that you need to be evaluating as a fund manager. One is, where are we in the macro cycle? And that is like, not only just like where public equity is going and how are public markets going to perform, but also like, you know, for crypto AI, for instance, like where are we in the AI narrative, like outside of crypto, external to crypto, like where are we in this? If this company is building an energy product in crypto, like where are we in the energy meta, right? So you need to be aware of what's going on in the macro and where we are in the narrative there. And then 2, you need to know where we are in the crypto cycle. Obviously, this space seems to run on a halving schedule, and so understanding when to anticipate bull markets is really helpful. And then the last thing is bringing it a little bit more detailed, more micro. I know we've been focusing on the macro for the previous 2, is this founder executing on the things they were going to execute on at the time that they said they were going to execute on them? And your decision to sell is assessing those 3, assigning them different weights, and then um, evaluating those across, like, against the premiums that you're getting on offers for the company, like particularly if this is a secondary transaction, or whatever the going price is in the market, and then making the decision. That's what your LPs are paying you for.
I would assume macro has got to be the highest weight because, like, it could be a stellar if this is crypto specific, like insane founder, the crypto cycle. Well, sorry, macro and crypto cycle. But if we're at the tail end of a macro and crypto cycle, it's like the founder could be, Elon, and like the token's going to suffer, right? Or do you not really? Which do you weight the highest?
It depends on the company. That's why there's a fixed weight for all of them, right? So, um, you know, the math would be very different for like a poly market, for instance, than like if you had done a macro assessment or crypto assessment versus the founder. All I'm saying is that it's different math based on the company and the opportunity. And I really
Yeah,
do mean it when I say you have to assess all 3 individually, and there's no fixed weight attached to any of them.
totally. Yeah. No, more of an art. Yeah, it's crazy. All right. So, all right, 10 years from now, where is Vault? Where's Suna?
Oh, okay. Well, as soon as that bolt and and I think we'll still be in New York. But 10 years from now, look, like our North Star has always been to be the best, pre-seed seed fund to our founders. And so a ruthless, disciplined focus on early stage and being the best partners that we can be to our founders, and the rest takes care of itself.
Amazing. All right. I want to switch gears here a little bit to kind of big picture questions. What are your thoughts on DATs? DATs have been like all the rage over the past, I'd say this year. What are your thoughts there? Some people hate them, some people love them.
It's a little bit more nuanced than that. So, one, I think most of them are trading below MNAV right now. And so the narrative is dying down a little bit, and momentum is dying down a little bit. And I think it's just the top few are going to attract and continue attracting more interest and liquidity. So not all DATs are the same, and um, a few of the ones that have been really successful. One of like the patient 0 or patient 1, I guess, is Meta Planet, and you obviously know the story there, where it was a Japanese hotel that was nosediving, and then they put together a treasury, like they call it like the Japanese MicroStrategy now, where they were able to put a DAT together and completely save the company. And the reason was because of tax treatment of Bitcoin assets versus something that like looks more akin to an ETF is just very different in Japan. And so it ended up making all the economic sense in the world for people that wanted to get exposure to Bitcoin to do it through MetaPlanet's vehicle. Similarly, I know there's like there are DATs around assets like Hyperliquid, or assets that you cannot easily acquire in the jurisdiction that you're in, the direct asset. And so having exposure to it through a DAT, which is very similar to an ETF, makes sense. So when there are when there are reasons are unique to getting access to a DAT that are not true when you actually buy the asset directly, I think that makes sense. Um, Otherwise, I just don't understand. I just don't know why you wouldn't just buy the asset directly. Like, you have more control over the the exit, you are not banking on, and a large part of this is people banking on the person actually managing the assets and their ability to manage liquidity. Like, that's purely it. I joke that it's a suboptimal ETF. I think other companies have large positions that they are trying to get liquidity on, and so they'll just lock them up in a treasury and allow people to get exposure to that asset that way, and they'll be able to realize on their end some liquidity. Overall, we're a pre-seed seed fund. DATs are not really that relevant to us in terms of what our strategy is, in terms of what we focus on. I think a few are performing well. The rest are trading below MNAV. If it gives you unique access that you otherwise wouldn't be able to have when directly purchasing the underlying asset, then I think it makes sense. Otherwise,
For AI, I feel like right now, obviously AI is like all the rage in many different aspects, but especially the infrastructure build out with data centers. How are you looking at AI when it comes to crypto? And is there any crossover between AI, crypto, and like the infra side?
TBD on where all this lands. I think some of the most compelling use cases are around being able to create networks where you have redundancy if one node goes down. Essentially, this is like a huge part of the distributed compute thesis. Um, to be able to have redundancy and reliable access, I think on the infrastructure side is important and continues to be important. Data marketplaces for fringe, harder to access data is important for training. There are some companies building around um, for use cases that are more sensitive around data, like financial products or health products. There's an interesting challenge around how to build products that are trained on data that you can't actually use. And so people are trying to solve this in different ways. Some companies are using FHE, some are looking to federated learning, which is already in use in a centralized fashion, but they're decentralizing another part of like where the weights and params are sent. And so yeah, and so that's all to say these are, in fact, I think most of the most compelling crypto AI products are not applications, they're actually more on the infra level, but we'll see where this all goes.
What do you think is the most significant opportunity within the crypto sphere that people are not paying close attention to right now?
Exactly what we're talking about regarding the robotics intersection and space intersection. I think there are um, these companies being built at the intersection of deep tech and crypto that are massively slept on and are being eclipsed, with narratives that are seeing a lot of traction and success, like RWAs, like tokenized equities, like prediction markets, which are all in their own right incredible categories and deserve all like the traction that they've been getting because of the successful strides that they've made. And then there's just this emerging pocket of these deep tech crypto intersection that I don't know if it's because they seem so far out or because it's not as legible in terms of the work that they're doing, are kind of dismissed by investors. But one of the most important pieces to those companies is that while some versions of them have existed in prior cycles, this cycle, you actually have domain experts that are building these companies. So these are people that have only built robotics companies before, that have come from the space sector, right? That were at SETI, that have these relationships with like, with SpaceX, with all these like blue chips in space that are choosing to build in crypto. I cannot emphasize how important that is. And to me, that is just a clear indicator that this time is different.
Amazing. All right, Suna, it is time for the closing questions.
Oh, okay.
Alrighty. All right. So you have to tell portfolio companies to build on one chain for the next 3 years. Which chain would you suggest or force them to build on?
I do not force the yeah, actually, do you know our firm is, like, really in fact, like, we're anti and pretty agnostic, encouraging one chain, and the reason is our framework is, what we're looking for is not the ecosystem you build in, but your logic or framework for choosing that ecosystem, and the reason is because not only obviously are you looking for just intellectually sound decision makers, but also the chain that the app ends up building on oftentimes changes over time, right? You can start off on one ecosystem, and either through integrating multiple chains, or building your own, oftentimes building your own protocol, or building your own, yeah, your, or just pivoting from Ethereum to Solana, or vice versa. Like, there's what we look for is just sound reasoning around the ecosystem they choose, not necessarily the ecosystem that's chosen.
That's fair. All right. What is the best advice you've ever received?
The best advice I've ever received, it's so simple, and it's actually from my mom, like always. It was just 3 words. It's just keep going. That's it. It's as simple as that. Just keep going.
Do you like call upon that often? Like, do you find yourself thinking about, hey, my mom's advice to me, and it keeps driving you forward?
Oh, yeah, yeah. I mean, even when I was a kid, and it's just always in the back of my mind. It's just like, just keep going. It's like things are going to shit, and there's the chaos is reigning, and it seems like FTX is collapsing, and this Luna, whatever they're doing, just keep going. Things are going well. Bitcoin broke 125K yesterday. You just finished raising this fund, whatever, just keep going. Like, it's just nothing. Like, if things are always in motion, things are always going. It's just not being deterred by the lows, and not resting on your laurels during the highs. You just keep going.
Love it. All right. What makes you pessimistic about the future of crypto, and optimistic?
What makes me pessimistic about the future of crypto, which is not unique to crypto, it's also, you know, just symptomatic of any early sector making a lot of money, and you're seeing it in AI as well, is a combination of like the nihilism and grift, mercenaries that come in to flip a quick buck, that harm other people in the process, and that's just sadly a bug of every space that is emerging, and printing money. And then what makes me optimistic, I guess, is the inverse of that, is just the people that have stuck it through multiple cycles, that have their eyes on the prize, that are lifting people up around them, that are in it for the right reasons. And so it's funny, like, there's a group of people that are detractors, and there are a group of people that are additive, and just making sure that you're always around the people that are um they're on the right, they're charting the right path, and making sure you're one of them as well, I think, is what keeps us going. At the end of the day, the industry is people. Like, we're all people building technology and investing in technology, but we are all, it's the company you keep. So
That's great. All right. How has being an entrepreneur and fund manager changed you as a person?
when I was in high school, I used to say debate was I was on the debate team. I say that, like, that vehicle was an accelerant for personal growth, and now I say it's entrepreneurship. It's being a founder. I think that is the vehicle to accelerate personal growth and development. Um, I you just don't come out the other end of founding something the same person you come in. You're just a lot more resilient. Um, I think you have a stronger, more refined inner voice. Um, and, yeah, I think those are like roughly the major ways you change as an entrepreneur, is that you just become more resilient, and you develop a stronger intuition. And I think that you also just become a better judge of character and people around you, and invest more in your community. I think going through it, you realize that, again, it all just comes down to the people, and taking care of your people.
Love it. Love it. Suna, thank you so much. This has been incredible. Where can people connect with you and learn more about Volt?
We have our Volt Twitter account, so it's at Volt Capital. I keep my DMs open on my personal account at Soona, and you can also email me at soona@volt.capital.
Amazing. Thank you so much.
Thank you so much, Andrew. This was such a pleasure.